Of the DiLella Center for Real Estate at Villanova. So welcome, this is our second annual panel like this, and this one's much bigger than the one last year for those of you who are here. So first thing I want to do is thank all of our panelists and our moderator for coming tonight, and they'll all be introduced later, but it's a great panel. It's going to be an exciting conversation. I know there's a lot of uncertainty in our industry right now, so we have we've been talking a lot already today. Our advisory council did today, so the discussion's been really great so far. I think it's going to be a good night. So it's good to have our students here. It's good to have the industry folks here. Just a couple of ads. I gave one for our students. Since you're all sitting here, we have another big event this weekend. We have a tailgate on Saturday. So if you're interested in the tailgate, flip to the back of your programs and you can find out where to, one, find contact information to find out about how you get one of our great students as an intern or an employee. And everything, you actually talk to Tim Hoffman, who's sitting in the room somewhere. So just talk to Tim about everything. He does pretty much everything except talk at the panel, at the podium right now. So go to our website and you can find our students. You can register for the tailgate on Saturday, which is going to be a great time. It's number 2 versus number 5, the first nationally televised CAA game ever. It's on Versus, so we're trying to get a bunch of people at the game and the tailgate. We have victory beer at the tailgate, so it'll be a lot of fun. So come and we'll have fun. We'll all wear our jeans and sweatshirts on Saturday and be more comfortable. So welcome to that. One thing, we had an advisory council meeting this morning, and one thing that came up was there's a lot of interest in the center. There's a lot of interest around the region and obviously in commercial real estate, and trying to have a nice place to go and have these kind of conversations. So we're going to work on some membership structures for the center so you can feel like you belong to something, and we can have more of these events. So be looking in now we have your email, so be looking in your inboxes for information on how to join the center. There's a lot of good programs going on, so that'll be coming up soon. And lastly, I'm going to introduce the dean, who we're lucky to have. He was supposed to be in Boston, and I decided to be with us. So Dean Jim Danko is here to say a few words, and I think introduce at least our moderator, who happens to be his buddy. So Dean Danko, thanks for coming tonight. It's nice to have you here. And welcome, everybody.
Thank you, Sean. I want to certainly commend Sean and Tim Hoffman on all their efforts with the Real Estate Center. This is something that was, simply an idea 2 or 3 years ago. I've been here now 4 years, and I've been hearing about real estate and certainly seeing the success amongst our alums in this area. I remember being visited by a couple students about 3-4 years ago that were also saying they wanted to see more real estate courses at the business school. So it really was a natural fit. We had great alums, we had great students, a lot of interest in the Philadelphia area. We were very fortunate to have a great benefactor, DiLella, who stepped forward and provided the financial support we needed to get this off the ground. So I really want to thank all those people. There's people in the room here or two amongst you that are on the advisory council, who too were quite encouraging of our efforts to get this off the ground. And it really fits very well with the Villanova School of Business. We really have focused a lot of energy on connecting theory with practice and to assure that the type of business education we're providing to our students is relevant, leading edge, provides them knowledge and insights that they need to be successful in the current global economy. So this fits quite well into the things that we're doing. I commend everyone that's been involved with the center, and it's great to see an idea come to fruition and for us to make these connections. Certainly want to thank you all for being here and for your support. It's great having our students here as well, and it's always nice when they come out to these type of events, because I think it really augments their education. I am very pleased tonight. Sean mentioned that Dave Hartzell, who's moderating this, is a friend of mine, and we actually go back 10 or 12 years when I was at UNC Chapel Hill for a period of time. And we've been very privileged to have Dave Hartzell here for the last month visiting with us, providing his expertise. He's been in a number of classes. He's agreed to moderate this session for us. He truly is one of the most distinguished real estate professors in the world, and I think we've gained quite a bit from his time here. And also personally, as a friend, he's a nice guy. I won't tell you any of the other stories, but if you catch me later, I can fill you in on that. Just to give you the official background on his resume, he currently is the Stephen D. Bell, Leonard W. Wood Distinguished Professor in Real Estate and Professor of Finance at UNC Chapel Hill. Formerly VP at Solomon Brothers, where his group focused on institutional real estate finance and investments. His group also was the first to bring commercial mortgage-backed securities to market. Is that a good thing?
So he's responsible.
Probably not. I don't know if he's taking credit for it on his resume. He did serve for a period of time as president of the American Real Estate and Urban Economics Association. He's very, very well connected to the industry. He brings a lot of practical experience to the theoretical knowledge that he has in this area. And so we're very pleased to have Dave here, and I'm just going to turn the program over to him. Dave?
Thanks, Jim. I think that's the first time you've ever said anything nice about me. I appreciate that. Thanks everybody for coming tonight. This is just a unique experience and opportunity, I think, for everybody. Let me say, first of all, how great it is to be back in the town which I was born. I was born in Philadelphia. I grew up in Wilmington, Delaware. And every time I get the opportunity to come back, I absolutely love it, especially when I get to see the Phillies clinch the NL East, which I did last night. Thank you very much. Being here at Villanova, I've been here for about 2 weeks. I'll be here for another 2 weeks. It has been just a tremendous experience. The momentum that the real estate program has here is immense, thanks to people like Jim and Sean and Tim, and the quality and the strength and loyalty of the advisory council that met this morning. That potential, I think, is realized in the students. As Jim said, I've been really fortunate to spend a few days teaching in the classroom here, and it's always just great to be around kids like this. They're smart, they're fun, they're intelligent, and they're extremely interested in real estate. And I'm gonna embarrass all of them actually right now. And I'm gonna ask the students to stand up so you can just so everybody can see how many of them are actually here, and also so that you can pick a couple out. We're gonna have a reception afterwards for about an hour, and it's everybody's charge here that's not a student to come up and say hello and meet some of these guys. I think you'll be very, very impressed by the students that are here. We call it Chapel Hill, and we've had a real estate program for probably 30 some odd years now. I've been there for about 25 of them, and we call kids like this the true believers, right? Who wants to get in the real estate market in this market today? And these, as I said, we have a great group here who are extremely interested in real estate despite what's going on, and recognize the opportunity. So I want to thank all the students for coming out tonight too. We have a great lineup of speakers tonight, and I'm going to introduce them to you in just a second after I've just made some very quick introductory comments, if you don't mind. And I think the bottom line is, and I hate to say this, but what I'm going to try to do is convince you that I am extremely confused. This is one of the most confusing times in the marketplace that I've seen. I've been through now 2.5 cycles since the mid-'80s when I first got into the business. And what I see in the marketplace today are so many crosscurrents, which is what we named this thing for tonight, in both the economy and the fundamentals of the real estate markets, and particularly in the capital markets, creating a lot of uncertainty in the marketplace. Surely there's some good stuff that's going out there. Surely there's some bad stuff that's going out there, and I think every day what we see are reports in the newspaper that you read one thing that says, man, everything seems to be picking up, and then, if you will, in terms of this uncertainty, would fall into several categories, right? One of the things that we always hear about in the marketplace today is how much distress there is, right? And you know, there is a lot of distress out there, but I don't think we've seen the tip of the iceberg yet. And the question is, and we'll sort of talk about this with the panel, is what exactly is it going to take to bring more distress? Certainly people are distressed, there's no question about it, but I don't think we've seen what we might have expected when we were sitting around talking about a year ago with respect to loans and financing and the equity that's out there. One other thing I hear is that there's just a ton of money waiting on the sidelines. And man, I'll tell you what, I meet with a lot of pension funds and institutional investors, and you know, a lot of people who are raising funds, and while there may be, maybe there's not so much out there as well, and we'll talk about some of that stuff today. I was told this to some folks this morning. I think everybody that I know is starting a fund. Yeah. And maybe some of you guys are too. I may even start one. I don't know. But you know, it's a long-term investment fund. It's a core fund. It's a distressed debt fund or a distressed equity fund, or it's a mezzanine fund. And I wonder where are all these people getting all their money? Surely there's a lot of dry powder that's out there waiting to be placed. But the question I always have is, what's the impetus? What's the trigger that's going to bring this dry powder back into the marketplace? Surely, we heard about the bid-ask spread, I think, when we met here last November, and and still we talk about the wide bid-ask spread that's in the marketplace with respect to properties coming onto the market, how much sellers are going to actually take for it. I would say that what we see is a trickle of projects to the marketplace. I saw that Heitman bought 2 retail assets from Macerich today or yesterday, but it's not in sort of the gusher size that maybe we might have expected. As in past cycles, public equity was the first sort of to go down on the commercial real estate side, at least on the equity side, and that's bounced back very nicely. Also, as in past cycles, private real estate, or at least how we measure it with NCREIF, is yet to have taken its final tumble, I would say. And we'll see some more shoes to drop on that side, I think, as well. But again, if you look at public equity markets, the pricing today is roughly about where it was 8 years ago, in 2001. And I think that we'll see, which I find striking in a lot of ways, especially as it relates to where do we go from here, which is one of the things that we'd like to talk about later on. And then the last thing that you hear is, I was in a meeting a couple weeks ago, and somebody said, this could be the best buying opportunity of our lifetime. And everybody said, wow, that's great. You always make more money in a bear market, make better deals in a bear market you do in a bull market. And then he said it might also be the best buying opportunity of our lifetime that never happens, which again is sort of interesting in terms of that. Again, I think we're certainly seeing a bear market when these good deals are done. We've got a global recession. We've got weakening fundamentals, illiquidity in the capital markets, a very wide bid-ask spread, and ultimately what that means, as I said earlier, is that we've just got a lot of confusion in the marketplace, and hopefully we'll shed some light on that with our panel tonight and the questions that you all present and provide. Let me introduce our speakers again, and this is a very timely time to bring these folks together. To my left is Joel Rassman, who's CFO of Toll Brothers. Housing arguably was the first thing that brought us into this credit crisis, and Joel's going to give us his perspective on housing markets today and what he sees going forward. Second next to Joel is Dan DiLella from BPG. Dan's going to give us his insights on the private equity markets. Some valuation, we rode up the private equity markets in a big way. And we were talking back in the back a little while ago where you try to raise half a billion dollars of money in a fund, and at the end of the day you're turning away money that comes in after you've already raised $1 billion, which is the bad side is then you have to place that money. But we're seeing that was again sort of the growth sector there, and what Dan's going to talk about is pricing and the outlook on the private equity side of the business. Third is Richard Parkus. He's right in the middle here, and he's head of CMBS research at Deutsche Bank. You've probably seen some of his reports that have come out talking about the coming distress in the marketplace as loans and CMBS deals hit their maturities over the next 3 to 5 years. It's really good stuff and very good research. And he's done some recent stuff on how what's happening in the marketplace today is going to affect commercial banks, which not a whole lot of people are talking about, particularly from this perspective. Richard's going to give us some insights on that. Next is Brent Morris, who I'm particularly proud to have here today because he's one of my old students from the University of North Carolina, and we brought him up here for a little accent diversity. Brent hadn't been in Charlotte for a long time, or in Chapel Hill for 10 years, but I'm pleased to have him here. And it says he's with Capmark, but as of today, his group in Capmark is with Erdang. And maybe he can talk about that. He's going to talk about private debt and the whole loan market. And last but not least, in the end, is Brian DiDonato, who is a Villanova alum. And he's going to talk about public equity valuations, fundamentals, and he may not know this, but he's going to tell us how we can all make money in this marketplace. Yeah. And I did want to show one thing just before you think, especially the two knuckleheads on the end, are this is thanks for sending.
Yeah, I'm so glad I sent that to you.
Thank you very much. This is these guys with some other guy at the game. This was just when the Phillies clinched last night. Thank you very much. And,
We were preparing for our presentation.
and I didn't take the picture, but I could have because I was preparing. The interesting thing I think is, and this is why we pulled together the panel. We've got a home builder, we've got somebody from private equity, we've got somebody from public debt, we've got somebody from private debt, and we've got somebody from the public equity side of the marketplace. The old paradigm is the 4 quadrants: public, private, debt, and equity. And what we wanted to do tonight is try to bring those 4 quadrants together and hear about some insights about what's going on to the marketplace, in the marketplace today. So that's it for me. Let me introduce Joel Rassman from Toll Brothers. Thanks for coming tonight.
Thank you, Dave. Talking about accent diversity, as you can tell, I'm not originally from Philadelphia. I'm originally from New York, and being here for 25 years hasn't gotten rid of my accent. So I apologize for those who don't understand New Yorker, and I'll try to speak a little slower. If you need a translator, just write down notes. I'll translate afterwards for you. And it is a very confusing time. It's a very confusing time, not only in the commercial world, but it's a very confusing time in the residential world. Before I go into any kind of conversation, since I don't know what kind of questions we're going to have, and we'll talk a little bit about the future, I'll just caution you to read what we do, a statement of forward-looking information that says, don't hold me accountable for anything I tell you, because it's not going to happen. It may not be the truth, and it may be subject to all kinds of variances. So if you could read that writing, it's there. If not, you can read it on the website for Toll Brothers or in all our public filings. Toll Brothers is the nation's leading builder of luxury homes. We began in this business 42 years ago in the Philadelphia suburbs. And it's kind of unique to be a home builder in the Philadelphia suburbs because for many people who, in this audience, you may not realize it, but from the late 1950s until roughly 1983, Philadelphia had a huge population outflow. And the one thing you don't want to be in an area that has huge population outflow, which means there are a lot of vacant houses, is a home builder. And so what we did is we looked for a niche in the home building market that could still prosper, even though there were more homes in the market than people needed. And we found that to be in the move-up market because there are always successful people, even in economies that are suffering, that need housing. So that's why we ended up in that particular part of the market. We've been public for 23 years on the New York Stock Exchange, and we expect to deliver this year between 2,580 homes and 2,830 homes. And to give you an idea of the comparison of what's happened over the last 4+ years, in 2005 we delivered 8,769 homes. So we're down 2/3 from where we were. Inside ownership in Toll Brothers is over 20%, and we are one of the only 2 brand names in the industry, the other being Del Webb in the active adult part of the business. There are a lot of things that started this home building downturn, and a lot of blame that can be put on a lot of different people. We can talk about underwriting standards disappearing and the mortgage bankers. We can talk about Wall Street's need for product and how they looked the other way and made new black boxes with all kinds of problems and the sets of assumptions they did. Well, one of the things that got talked about for a little while but has been forgotten is a lesson that at Toll Brothers we learned in the 1980s when a gentleman called Jim Murray, who had just been promoted from head of real estate on the West Coast, came to the East Coast to head all of real estate for Chase Manhattan Bank. And we asked him, we were a very small company, and we said, why is it that residential pricing and housing in the West Coast is so much more volatile than it is on the East Coast, or any place else in the country? And he said, pardon my language, it's those damn investors. And we looked at him and said, investors in single-family homes? That's crazy. And then we started to think about it. And in fact, there was a little bit of investors in the 1980s, but not a very large amount of investors in the 1980s, whereas 15 or 20% of the business in California was investor business. People buy houses instead of buying stock to invest in. That's an important differentiation. Well, we all forgot that lesson. And then in the end of the 1990s, all of a sudden, investors started to come and hit the East Coast. And it was particularly a dominant part of the demand in the Washington, D.C. market, which when you think about it is understandable because the Washington, D.C. market is a market where there are a lot of transferees from all over the country. A lot of people come in for short periods of time, and they are very savvy in general. And so you had, in the Washington, D.C. market, probably 15% of the buyers who were investors, but none of us really understood that. Investors, all housing, is a function of consumer confidence. As we saw now, there's no consumer confidence, therefore there are very few houses being sold. No place more is consumer confidence important than it is, particularly in Washington, D.C., which really relies on the confidence of the country in its president and its government. And in 2005, we saw Katrina come in and destroy a significant portion of Louisiana, Texas, and we lost confidence. Just remember the pictures of what devastation we saw in our government's ability to manage. And we saw that impact on the investor psyche in September of 2005. We had given a speech in August of 2005 that said that the price of housing had gone from double digits down to low single digits in terms of appreciation. And the typical, with hindsight, we know the typical investor was buying a $500,000 house, would look to rent it for a 6% cash-on-cash return, or $30,000 net rental income, and would look to get 4 or 5% appreciation. But they didn't get that. They, in fact, got 10, 15, and 20% appreciation in the Washington, D.C. market. So that 2001 $500,000 house became worth $950,000 by 2005, the end of 2005. But they still only got $30,000 a year in net rental income, which was a little over 3% return. And when you saw housing appreciation go down, they no longer got an adequate return for their risk. And so the investors stopped buying houses in September for two reasons. One is the loss of confidence in the government, and the second was the loss in belief that they can make sustained and adequate returns on those investments after September. That took roughly 15% of the market away in the Washington, D.C. area, but then something else happened. These investors were smart enough to say, wait a minute, if I got a $950,000 house, that's only appreciating now at 3 or 4%, and I'm only getting $30,000, I should sell that house too. So not only did you lose 15% of the demand, but you had 2 or 3 or 4 years worth of 15% previously bought starting to be put on the market. So we saw for the first time since the early 1970s a very rapid deterioration of housing prices in the Washington, D.C. market. It was the first market in this country to go down. Starting in September, and by November, prices had already gone down over 10%. So you had this calamity that was ready to hit, and that the media picked it up, and the media started to say, well, if it's going to happen in Washington, D.C., why wouldn't it happen elsewhere? And we heard this conversation about a housing bubble, and that got investors all over the country, because investors were now in Arizona and Las Vegas and in Florida, as well as in California. And you saw investors leave the market and start to put housing on the market as well. So now we're 4+ years into a down cycle. And normally, when you have a housing recession or a down cycle, you normally end up with a recession in the economy, but that didn't happen right away. We went to 2005 and 2006 and 2007. It wasn't really until 2008 that we saw a recession, which means we were 3 years into a housing recession before we saw a national recession in the economy. So now we're 4+ years, and we're in a very difficult time, and I'm not sure I'm going to be able to tell you when we're coming out of this time, so I'm not sure I'm going to give you a lot of insight to that. But you can understand that we're sitting in very tough times because We still have mortgage problems, which makes it difficult for people to get housing. And we have unemployment rates, which are around 10%. We also have a tightening of credit. However, just like the seeds of the housing recession were planted earlier, the seeds of a recovery are now being planted. And we started to see signs of seeds of recovery, although it may be very slow, appear in about the third week of March of 2009. Actually, for us, it was the week of March 22nd, but most of the builders saw it roughly the same time. And for our third quarter that ended July 31st, we had more signed contracts in that quarter than we did last year in the same quarter, even though we had 20% less communities. So that was a very positive sign. And for us, communities are like a retail store, so it's the same store kind of statistic. We also have the government saying that housing supply of new construction housing is at 7.5 months, which is a reasonable supply of housing. But please remember, all the government statistics should be looked at with a little bit of judgment put in, because it's done with surveys and it's not necessarily the most accurate, but it's still a better sign than having a year or a year and a half's worth of housing in there. And we also have mortgage rates at all-time lows. So we've got a lot of things that are ripe for a return of housing. More people starting to realize that. They start to realize that housing is maybe a good investment, and so we have very good affordability. Right now, the July index of affordability is at 158, which means that 158% of the families in this country can afford an average priced house. Another way of looking at this is the percentage of income a family needs to own a house. It used to be, when I grew up, it used to say 25%. The actual statistics on average was 24%, and today that number is 17%. So we're at a very good affordability situation. And while the consumer confidence started to rebound also approximately March and continued on basically until last month, we saw housing improve. We as an industry used to deliver between 1.8 and 2 million and change total number of housing units a year on average. And that's for the last 20 years, not just the peak of the market. And that includes apartments and single family. We reached a low as an industry of someplace around 350,000 annualized units. And today we're at, according to the government, over 500,000 annualized units. So it feels really good to go from 350 to 500, but we're still at a 75% decline from where we were on average just a few years ago and for the last 20 years. So we got a long way to go. But the demographics still favor housing. The baby boomers are on their peak home buying years. They're moving into the empty nester and active adult product, because there isn't a lot of old resale product to satisfy that need, so new construction is really the way to go. And the children of the baby boomers, which are the students that are here primarily, they're, as they graduate, they're looking for housing too. And they're forming families. And in fact, fundamentals are very strong. Household formation continues to go. The Harvard study, the last Harvard study on joint housing indicated 1.8 to 2.2 million units were equilibrium. That means supply and demand would be in balance. That consists of roughly 1.4 to 1.45 million new households formed a year, about 450,000 houses that become obsolete, and another 250 to 450,000 houses that are second homes that are needed to satisfy the baby boomers and middle income people's needs for a second house. We're not building that. We're building 500,000 units a year. So we're building up pent-up demand, and that's good for the future as well for our industry. In addition, for those of us that will be around, we'll have fewer competitors. The last statistics that I have been quoted, I have no way of proving it's being correct, is that about 50% of the providers of housing are now out of business. My estimation is it'll be going up continually for the next year or two, because the companies cannot get money from the banks. And if they're alive because the banks don't want to foreclose on them, because then they have to write down their loans, but they have no capital available to operate. It's not likely they're going to have capital in the future. And therefore the builders who are around, will have a bigger and bigger market share. So we don't have to get back to 2 million units to be a very vibrant public home building industry. At 1.5 million units, we'll all do much better than we ever did before, and that's only 3/4 of the average demand that's been for the last 20 years, because there'll be so many fewer suppliers of housing. As a company, we focus on the strength of our balance sheet. We had a 14.5% net debt to leverage at the end of the year. That was down from 18% a year ago, and historically this industry has done net debt to leverage is over 50%. For the first time in over 3 years, we were the first home building company to access the capital markets in April. We raised $400 million at 8.91%. To give you an idea of what a feat that was, our paper on the resale market was being quoted at 10.25 to 10.5. So for us to go out with a new issue at 8.91% was a tremendous feat. And since then, we just did a new deal this month, 6.75%. So capital markets are available for public home builders, but not for the small home builders. We tendered and retired debt when we did our first deal, and we tendered and retired debt when we did our second deal, so we've effectively elongated our balance sheet, making us even stronger. And other than $47 million worth of sub-debt that's still outstanding, we don't really have a lot of debt due until 2014, so we're in pretty strong shape. So I think what's going to happen is you're going to see this continued difference between the small builder, where they'll be disappearing in the marketplace and have difficulty coming back, and the large builder. As an industry, 10 or 12 years ago, the top 15 or 20 home builders probably had 5 to 8% of the market share. Before the crash took place, for the bubble burst, we had about 25% of the market share. My guess, when we get out of this and we can measure with real numbers, the market share will be significantly higher of those of us who survive. So we'll be in great shape. Thank you.
That's great. Thanks, Joe. Appreciate it. Hey, Joe, one of the interesting things, especially about housing, is government policies that impacts housing. We were talking a little bit yesterday about some of the housing policies that maybe help to provide an opportunity for some of the weaker borrowers to buy homes. And I'm wondering, I saw in the paper today about banks being willing to reduce principal and things like that. I'm wondering how you see policy and sort of bank activity impacting what you guys are doing in the marketplace going forward.
Well, the only reason we have even the 500,000 units a year being sold is because the government has decided that you have to keep some housing market available. And you have Fannie and Freddie and FHA. And FHA used to be a very small part of this business, less than 5%, and today, I think the last statistics, it was in the high 20s or low 30s% of mortgages being provided in this country, which has its own risk because FHA is potentially insolvent at this point, and the government's going to have to subsidize to make it happen. So government policy is really important. We also have an expiring tax credit, which for most people is now no longer available since it expires at the end of November. And there's been discussion about that first-time home buyer credit being extended. I think there's probably a 50-50 chance of that. We really think the right answer is to extend it to all housing and to increase it up to a maximum of $15,000 or $20,000. Had the government done that 2 years ago when it was recommended, we probably would not have a housing crisis today because housing prices would have stabilized. But with hindsight, it's always easier to say what should have been done.
Always the case. Great. Thanks, Joel. I asked these guys to do 10 to 12 minutes of speaking, and it was nice when with Joel because I was in control of the thing, so I was speeding him up. Now I wasn't doing that bit then. Now I'm kind of loath to turn this over to the guys, to turn this over, but I will give you the hook after 12 minutes.
I won't get 12
10
minutes.
minutes, right?
You were a little bit long. That was good, though. Very good.
I warned you.
You did, thanks. Let me start out saying that there's an old contrarian. His name was Humphrey Neal, and he wrote a book back in the 1950s. And in the opening paragraph of his book, it says, "When we all think alike, we're all likely to be wrong." And that's really great for when we create bubbles in investments. But as Dave pointed out and Joel pointed out, I don't know any group of people who are thinking alike today. It just isn't happening. Everyone has an opinion. We've all been to different conferences. If there's 5 economists, everyone has a different opinion. So good luck on trying to figure it all out. I guess we're just putting out here information and seeing where it goes from here. This first overhead is from 1991. This actually was in the Philadelphia Business Journal in 91, and I guess if you're a student here looking at this, I guess your parents should be thinking about whether you're entering the right industry or not, but I think you are. Once you start, you're in forever. Here's an interesting, if you bought something where it's Sandy hot or where you make cars, you've lost. That's just one little section of what's going on in the economy today. And Florida, Arizona, inland Southern California, Nevada, and certainly in Michigan, if you have property there, it's worse off than in many other areas. And I guess housing has had its, as well as all the other types of products have had their problems as well. Here's an immediate outlook. Now, when I first had this written down at the top, I put down the next 2 to 3 years, but that was too depressing to put down 2 or 3 years. So I put down immediate outlook, and hopefully that'll make things a little bit better, because I'm kind of an optimistic person, and I just don't like thinking about anything that's going on that long. But as you can see here, there's nothing here that makes you feel better. And if most of this is true, the income going down, the vacancies are going up, the operating expenses, at least they're stabilizing or maybe rise a little bit. If some of those costs are going down, net income will decrease. Capitalization rates have already gone up. I don't know how much more they're going to go up. Cost of debt's higher, and of course the deleveraging by the banks is going on today. And that's another interesting thing, because we've had this discussion. We all started thinking back in 2008. And we have several investment funds, and we have a fund now where we have substantial equity remaining to be funded, or investment dollars to be funded. And we all thought, listening to people talk about a year and a half ago, that first quarter of 2009, things are going to be hitting the market. That second quarter, third quarter, fourth quarter, and now we're talking 2010. And I've met with many banks, and I've met with some of the investment groups, and I've talked to different people, and I'm getting to start to believe that I don't think this is going to happen. From the bankers that I've talked to, no one wants to take back property. They don't have the capability to take it back. They don't want to have the hit on their bank at this particular time. And you start to wonder, well, we had a call from a bank recently, which I met with up in New England, remain nameless, who said to me that, gee, and we had a whole group of people. We're in a conference room. We had 4 of our people, 4 of their people. And they said, we want to start taking back property. We'd like to joint venture with you. I said, well, give me an idea what you're talking about in the form. What do you mean joint venture? And he said, well, maybe we'll make you a loan to take the property back. I said, well, how about if you put the property in the venture and we become real partners, and then we work it out? And he said, well, that's a possibility. I said, depending upon what the assets are. But they have not at this time been taking back, and this was 6 months ago, they have not at this time taken back anything. Some of the major bank in the National Bank, we met with, and we were talking, and we extended some of our loans with them. They were very pleasant to work with. Didn't even want an appraisal. Don't get an appraisal. If you get an appraisal, we have a problem. Just, you're covering the debt service, we're happy, I'm happy, don't call the appraiser. And I know there's a couple of appraisers in here. Sorry, Joe, you're not going to get that business. And I was thrilled to death to hear that, so let's just move on from there and leave it alone. So I think, and everybody knows, everybody's heard the term extend and pretend. We're all doing that. So let's just push it out 2 or 3 or 4 years, and maybe we recover some of our equity. Maybe we recover a portion of it. I don't know. It depends on what the vintage of your fund will be. So that's going on a little bit. I'm not going to dwell on this next chart, because I think somebody else is going to spend more time talking about the banks. But if you can see, the stocks have gone up, and of course our failed industries are on the bottom there under failed and sold. The bank regulators, they continue to restrict commercial real estate exposure. Nobody wants to lend any new money. There are some smaller, mid-sized banks that don't have the real estate exposure. If it's under $30 million, we think is kind of the magic number, and you're willing to put in 65%, and it's got great coverage, and you've got willing to take some form of guarantee back, you'll find money. I guess that's where we're going to start again, but we've been down this path before. I heard Dave say this is his 2.5 cycle, I guess. I hope I look a little better than my age, but I started in '73 doing REIT workouts for a bank. And I spent the first 3 years of my career in Florida and Georgia as an asset recovery guy for a bank. So I didn't create the problems. I was in my early 20s, and I had a lot of fun. So We're back. We made a circle. We're back. Effects on commercial real estate. This is an interesting chart, and this is absolutely, of course, it's absolutely true. We've done 9 funds. 8 have a number like 1, 2, 3, 4, and 1 happened to be a co-investment fund, so it got out of sequence a little bit. We've done 9 funds. We were fortunate enough that we started in the early 90s. We basically retired 5 of those 9. 2 of the funds, the vintage funds from the early 2000s, we basically returned 100% of the equity. Our Fund 7, which is really the 8th fund, that was vintage 2006, 7, and a tiny bit of 8, not good. Our next fund, which I think Dave also talked about in the beginning, we were talking in the back of the room about raising money in 06. We went out with a fund that we wanted to raise between 500 and 650 million. We stopped at 850, and we certainly could have gone right through $1 billion. But as the problem with these funds, in my opinion, is that they've gotten the length of the horizon to actually make money is too long. It's 10 years. That fund would have been a 10-year horizon. So who's going to be around 10 years? Do you want to make it? Is it good? Of course, you're getting fees at the time, so everybody should be happy. That goes out a long period of time. One of the questions I think we're all asking ourselves as people run around saying they're going to raise all these funds, what's it going to look like? Where is it going? What's the return requirements that these investors or these LPs are going to want? What kind of controls are these LPs going to want? I can assure you, if it's CalPERS, CalSTRS, PSERS, Ohio's teachers, they're going to want to pound the flesh. They're going to want more transparency. They're going to want some more control, and they're not going to pay you the fee that you've been getting. So I don't know having all this discretion and tying up your funds and your people for 10 years is worth it anymore. I don't know what the structure is going to be. I'll take a guess that they're going to be smaller numbers. At least if I had my druthers, I would like a smaller fund, shorter period of investment period, get the money in, get a chance to make a return to pay your people. I'm going to venture, when I sit around a room, when I go to the ULI or PRIA or some of these other, AFI or some of these other organizations, and I talk to some of my peer groups that started funds within the last 5 to 7 years, they should be collecting on their promotes now. But they're not. They didn't make any money. They made fees, which is kind of a prepayment of your promote if you want to look at it that way. But they made fees. So I'm not so sure where we're all going with the structure of our funds, and I keep talking to some of the consultants, and they're not really sure either. But as you're looking on this chart, you can see from 2007 where all the money was coming from, and it proportionally went right down. It's every source is less. Here's we skipped you. This, Dave fooled me here a little bit. He pulled some of my that's okay. I think somebody else has that one now. That's all right. Okay, we'll go jump ahead. This is the sales volume, as you can see from 2001, and you can look up there at the year to date at 2009, and that's half of the post 9/11 and .com bust. And as you can see, the volume is non-existent pretty much. And the things that are trading, and I think I have another chart that shows that trading, basically, this is the one you left in. I thought you took the other one out. All right. You'll see that the trades are mostly where you're either financing, it goes with the transaction, or it's an all cash buy. There's not a lot of money out there basically providing debt. As I said, on occasion, smaller deals. 3 years ago, bigger was better. Today, smaller is better. There's another chart basically showing the same crises, the property sales, and you can see it's month by month on the top, and it's year over year on the bottom, and you can basically just look at it from a trend viewpoint. State of the equity markets. Now there's limited transactions. I mentioned that earlier. The pricing is down, anywhere from 25 to 45% of value from the valuation peaks, and obviously, I read somewhere. Obviously, it depends on how much leverage you have and what the impact is. In the last 18 months, if you have seller financing, lending, or something that will facilitate the sale, it's not going to happen. However, I'll make a statement. I even wrote his name down. His name is Bryce Baer. He's the CEO of Avalon Bay. He was on a panel last week, and since he's not here to protect himself, I'm going to regurgitate what he said. Assume some people know him here. He basically said that they sold an apartment community. I believe he said it was on the West Coast. And they have really good product, by the way. They do really nice stuff. And he sold it. He had 35 legitimate offers at a 6 cap. Now, I couldn't catch him afterwards. Everybody was kind of busy. On what income, Did he provide debt? Did it go with debt? What? I would have loved to have known some more of the details. However, I felt better when I left the room, since it was probably one of the only upticks that anybody ever talked about in that room. So it's if that's the beginning of something starting to happen, or as we continue to bump along the bottom, it made me feel better, so I'll pass that on to you. I'll let somebody else talk about the REIT market. As you can see, the cap rates have increased anywhere from 150 to 250 bips, and we'll see where that goes with the as the future goes down the path here. But this is a chart, interesting chart. On the left-hand side, you can see that what it would look like, and this is modest, 80% debt. I mean, there were some of the assets that certainly I know there was 90% debt, and all the tranches that went on with it. And if you look at the right side here of this chart, this is what it's going to look like today. Now, the interesting question here is that if this was a wonderful transaction at 80/20 and you had a building that was fully leased and great rents, and it was still covering debt service, you may still own it. But if it didn't, you probably is going back to the bank now, or back to the special servicer, whoever they are. This is a transaction that happened in Boston, and this was done by the Beacon Group, but we happened to be an investor in it. And we were part of that 2006 sale. It was wonderful. Broadway Partners, I believe, bought this, and this is what it looked like when it sold after they were done with it. And this, between 2006 and 2009, it wasn't pleasant investment for them. They lost this in a foreclosure, and it went to sale. And I don't remember who bought it. Maybe somebody here remembers who bought this.
Right. It was the mezzanine.
Was it mezzanine?
The mezzanine investors.
Yeah, it didn't go for a cash purchase. It was actually taken back by the mezzanine bondholders, and the actual price isn't $745. Their basis is about $625.
Then it flipped out again, I guess. But that's it doesn't matter. It's pretty disastrous. Yeah. It's not good. It's not even at $725. State of the equity markets. I mean, I think they've also mentioned that some powder's dry. I think there's money out there. I don't know who. I hear people raising these funds. I've talked to some of the consultants from Cortland, Townsend, and some of the people Cambridge that we do business with, and they say that their people are not making commitments to these funds, and they're very disappointed going out into the marketplace. Although I keep hearing people, as you do, I'm raising a distressed fund, I'm raising a debt fund, I'm raising a mezzanine fund. One of the problems that we have seen in people looking for, and we've had people calling us looking for mezzanine money on a portfolio basis, when you read the PPM from them and you start looking at the covenants on their loans, and you start looking at the structure of their loans, and you just can't get past the first couple of pages. You're not going to put yourself in that position. And in my opinion, that's why some of this mezzanine debt just has not worked today. So when these people are raising all this money and raising all these funds, which I'm not sure they are, but they claim they are, I don't know where they're going to actually put it. I think things are going to trickle out. The other thing that I've made, and I don't have the answer to this as well, what are the return expectations? We were up here talking a little bit. I don't know where people are going with their returns. We're back to people saying, I want 20%. I want 25%. Is that realistic? I mean, is it 25% on what? I mean, if you're buying distressed today, you're going to be looking for those higher returns. More interesting for me, and a more important question, is what's going to be the normal real estate return under normal circumstances, probably with low leverage, going forward? What is that going to be? Is it 8, 10, 12? What? What's the core return? What's the opportunity return? Remains to be seen. REIT money, as he's pointing out, the public is putting up money. I mean, I just talked to Jerry Sweeney at Brandywine. Last week they raised $250 million at 7.5% on 5-year unsecured. Good for him. I'm glad to see that's happening. We're not seeing that in the private sector. The only thing we're getting is some concessions from our banks on various transactions by pushing out debt, but I don't see people raising the money out there with these funds. Here's a chart that I think someone else is going to talk about, but you can just look on then and then now, September, and you can see the jump in the cap rates on various product types and in various cities. And I can feel Dave breathing on me here to hurry. Owners and borrowers, you can see here, the 1990s, who owned the properties, the developers, and and there was partial recourse today. There are the LPs. There's the fiduciaries. There was a lot of non-recourse, although banks did take some recourse. There's a lot of carve-out recourse that's in there as well. And of course, somebody else is going to talk about the CMBS market, so I'll leave that alone. And my conclusion. There's going to be opportunities. New stars will emerge every time I've seen this happen. And good for some of you young people sitting in this room, because I think you may become the new stars in real estate. You may get the new fortunes. because people are going to come up with new ideas, and some of the old household names are going to disappear. You'll never hear from them again, or they'll retire, or they'll go do something else. So those fortunes will be lost, and here we are again. A new cycle begins for all of us, and you just need the energy to make sure you can follow through. Thank you.
Thanks, Ed. Student comes back. Can everybody hear us in the back, by the way? You guys all right back there? Good.
Make sure.
I should ask that probably a half hour ago, but didn't. I have a student that comes back, who's in Brent's class, graduated class of '99. He's been working with a private equity fund. He comes back and does cases in my class every year about deals that they're looking at. And when he first started coming back, it was looking at 22% for an opportunistic rate of return, and 17 maybe for a value add, looking at 8 to 12 maybe for core. And every single year he came back, it lost about 100 basis points, right? So at the end, the core was he was looking for a 6% required rate of return, 10 to 12 in value add, maybe 15 in the opportunity. I said, do you think the risk has really gone down here in these markets that you're looking at? And he said, I don't know, man, but we can raise capital all day long. So he wasn't that worried about it, but I think he probably is now when he's trying to harvest the gains from those things. Our next speaker is Richard Parkus, who's the head of CMBS research at Deutsche Bank.
Great. I'll actually come up. So,
It's not bad.
am I going the wrong way?
I'm not exactly sure what's going on here. Tim?
It is the PDF.
Sorry about that. There we go. Thank you.
Okay, great, thank you. It's a pleasure to be here. I run CMBS research at Deutsche Bank, and I'll talk a little bit about commercial real estate debt today, what we're seeing in sort of commercial real estate debt more generally. And then I'll talk a little bit about the implications that we see for banks outstanding. Okay. One of the things that we hear about today in the press, almost continually, I've heard this for the past probably year and a half, I still hear it today, is whether or not commercial real estate is going to be, quote unquote, the next shoe to drop. I'm sure everybody heard that question out there themselves. From our perspective, there is no question. Commercial real estate, the shoe has dropped. It dropped probably 12 to 18 months ago. The only question that we face today is how bad the situation will get. Very optimistic. When we look at expectations for how bad things are going to get, we think that it is going to be relatively close to what the degree of problems that we saw in the early 1990s. Let me just show you some pictures. This slide shows total delinquency rates in CMBS on all CMBS loans. It's a time series. The line to read is the dark black line, total delinquency rates. And you can see as of the end of the first quarter, at the end of March, we were at 2% total delinquency rates. If you fast forward today, we've gone from 2% to over 5%. Okay? What's unusual, or what's truly unprecedented here, is the rate of deterioration. We simply have never seen anything like this before, and that includes the early 1990s. Now, if you look back at the experience of the 1990s, in life insurance portfolios, we certainly saw very high delinquency rates, but we got there over a number of years. In CMBS, and in fact the same thing is happening today in bank portfolios, the deterioration has literally been within 7 or 8 months. So we've gone from roughly 100 basis points of delinquencies to well over 5%. We expect to be between 6.5% and 7% by the end of this year. Now, how does that compare to the early 1990s? Delinquency rates were depending on the loan vintage, somewhere between 5, 6, 7%. The worst vintage was 8%. So by the end of the year, we're already expecting loan performance on commercial real estate debt to be as bad as it was in the early 1990s. In fact, we think there's every probability, every chance that things will get considerably worse. Now, on those slides, what we were looking at was current loan performance. And as I was saying, we're seeing historically bad deterioration. But it's, in our view, an even greater risk out there is not what we call term defaults, which are simply loans that cannot generate sufficient cash flow to make their debt service payments and therefore default. Probably an even larger problem that we're facing is the refinancing problem. Now, commercial real estate prices are down. Well, we agree with Dan. I think Dan said 35 to 45%. We think that in the end, commercial real estate prices will probably be down somewhere between 40 and 50%. In certain markets, certainly more. If you look at Manhattan office, we're expecting 50 to 55%. We're probably very close to those levels at this point already. So when you consider loans that were made in 2007 with an 80 or 85 LTV, when those loans come up, some of them come due in 2012, 5-year loans, those loans, some of them have seen 40 to 50% price depreciation. And the allowable leverage has gone from, say, 80 to 85% to 60 to 65%. You can see that whether we're looking there at massive equity deficiencies. So we're really expecting to see very significant problems here. Now, we've done some work on the CMBS side to get an idea of just how extensive the refinancing problem could be. We've done very careful quantitative analysis, loan level projections using on rents and vacancies and sort of expected future financing terms. And the numbers that we're getting, what we find is that at least on the CMBS side, as many as 60 to 80% of the outstanding loans may well not qualify when they come up for refinancing. I'll touch on this in a minute when we talk about banks. But the similar, a very, very similar calculation would suggest that banks are facing exactly the same kinds of problems, and life companies, although a smaller to a lower magnitude, similar problems as well. So the issue, I think, facing commercial real estate is kind of twofold. At the moment, we're experiencing massive spikes in loan performance. Many loans just simply defaulting from cash flow stress. On top of this, when we look out over the horizon, we're seeing years and years of problems with loans coming due where the refinancing is going to be a very, very significant issue. Okay? The combined commercial real estate debt market is about $3.4 trillion. So we're talking about relatively large magnitudes. If commercial banks are similar to CMBS, we could see several $1 trillion of loans that don't qualify for refinancing. And then, I think as Dan touched on the issue, the question is, how do we deal with that? Will loans be extended? Will they be extended for long periods of time? Or will we see foreclosures? Just to, again, get back to a comment that Dan made, we're not seeing, and maybe David as well, we're not seeing the flood of foreclosures today that everybody was expecting, especially in CMBS. And the reason is pretty clear. Why are you going, if you're a special servicer or if you're a bank, why would you foreclose on a loan and take the property if there's no financing available for someone to come in and buy it? You simply can't sell large properties. Anything over $20 million in size, financing is effectively zero at the moment. So we don't really expect to see foreclosing in today's environment when capital markets are effectively shut to commercial real estate, or at least to reasonably sized loans, is not really an option.